The gentleman yields. The gentleman from New York, Mr. Garbarino, is now recognized for 5 minutes.
Thank you, Chairman. Thank you for the witnesses for all being here today. Originally set up to be an objective assessment of financial institution safety, soundness, and overall health, CAMELS has turned into an opaque process marred with inconsistency, and subjectivity. The management rating is uniquely subjective as it isn't based on any empirical standard. Initially, the management rating flowed from other ratings since it was a logical train of thought that if your bank has satisfactory capital, assets, and earnings, then it was safe to presume the bank was well managed. However, today it appears examiners have delinked the management rating, causing banks to potentially receive an unsatisfactory rating simply because they didn't manage their operations or conduct their businesses how the examiner mandated. As a result of a poor rating, a bank could face limits on acquisitions and potentially higher deposit insurance premiums for multiple years with no way to appeal the examiner's decision. Mr. Kennedy, can you describe how the management rating has been misused over the years?
Well, it's a difficult question because there's a lot of confidential information involved in that, but I think it's just it's a subjective, that's the unfortunate thing about CAMELS. Each one of those ratings and CAMELS are very subjective, and I've seen them in my 45 years of practicing law and representing banks all over the country, widely divergent in terms of those decisions.
Well, does the examiner, when a bank gets a low rating, does the examiner provide a detailed reason for the rating, or is there a mechanism for a bank to challenge that rating?
There is, but it's not effective.
How would you make it effective?
I think I'd make it more open and have an independent agency as suggested, I think, by the chairman.
So you can challenge the rating, but it should be more open, and you would use an independent,
Yes,
to
sir.
fix it, you'd use an
Yes, sir.
independent agency. Thank you very much. Mergers present banks of varying sizes, from community to regional banks, with the opportunity to grow and benefit from economies of scale. They also promote competition and generate cost savings that can be then passed on to customers and consumers. As the number of the de novo bank formations decreases, bank mergers have effectively become the only avenue for increasing competition. Fortunately, under the Biden-Harris administration, bank merger evaluations became more stringent, making mergers more difficult to complete. Rather than making the bank merger evaluation more subjective, costlier, and time-consuming, regulators should seek to provide clarity through objective metrics to evaluate potential mergers. Further, clear expectations and timeliness for merger approvals allow banks to make informed decisions on how to grow and meet the needs of their customers. Ms. Owen, can you explain how inconsistent timelines can impact decisions to merge?
Absolutely. It impacts so much more than people initially think of. It's not only a matter of putting the two banks together, it affects people's lives. There are jobs involved with mergers. There are the communities and decisions made of whether or not branches are going to remain open or whether or not they need to be closed, where operations centers are going to be located. It goes on and on and on. So there's a multitude of decisions and things that come out of or are part of a merger, not just what people initially think of, the combining of two financial institutions.
Do you have any recommendations on how we could fix what the Biden-Harris administration did over the last 4 years when it comes to mergers?
I am very much in favor of what Chairman Hill has proposed with a time frame for completing the mergers, unless there's reason to note not to do so.
Thank you very much for that answer. S2155 directed prudential regulators to create a simplified capital framework for community banks known as the Community Bank Leverage Ratio. As a result, a final rule was approved to allow community banks with a leverage capital ratio of at least 9% to be considered in compliance with Basel III capital requirements and exempt from the complex Basel calculation. The intent behind this section was to simplify the capital regime for community banks, ensure they maintain enough capital to weather a downturn. Ms. Romero-Rainey, at the time of this rulemaking and even in today, would you say that the majority of qualifying community banks that have at least 8% CBLR already meet the well-capitalized risk-based capital ratios?
Yes.
Can you please describe the benefits that community banks saw from lowering the CBLR to 8%?
Again, part of this was to allow for additional flexibility, and whether it's the definition of well-capitalized or as they're looking to pursue other opportunities.
That's a great answer, and I appreciate it. I'm running out of time, so I will yield back.